Unit 4, Risk and Return, Lecture 5, Portfolio Theory, Part A. We're moving now to portfolio theory and the investment decision-making process and how portfolios are constructed using modern portfolio theory. Looking at the investment decision-making process, we have a top-down process with 3 steps. The capital for investment will be allocated between the risky portfolio and the risk-free asset. The second decision is the asset allocation decision, which is the allocation across broad asset classes. And here we talk about equities, bonds, properties, cash, and so forth. And finally, security selection of the individual assets. This is when we look at a particular asset class, for example, equities, and we select the securities or investments we want to make in that class. Markowitz was responsible for modern portfolio theory, or at least the start of modern portfolio theory. And now we're looking at Markowitz's portfolio selection model. We're looking specifically here at the selection of the risky portfolio. And the first step involved in this process is to determine the risk-return opportunities available. So portfolios of risky assets are going to be constructed. The risk and return for each of these portfolios are going to be evaluated or calculated. And for a particular return, the portfolio that is a candidate for optimal portfolio is the one that will have the minimum variance. So across the different returns, I'll select the portfolio with the smallest variance, and that will be plotted on the minimum variance frontier. And the portfolio with the smallest variance of all is referred to as the minimum variance portfolio. So to reiterate, the minimum variance portfolio is the portfolio composed of the risky assets that has the smallest standard deviation, the least risk. For a correlation of less than +1, the portfolio standard deviation may be smaller than all of the individual assets. When correlation is -1, as demonstrated previously, it is possible to create a portfolio which is risk-free. So this is the mean variance criteria. A particular portfolio A will dominate portfolio B if the expected return on A is greater than the expected return on B and the risk of A is lower than the risk of B. If we look at an example, looking at portfolios W, X, Y, and Z and their relative or relevant expected returns and standard deviations, which one of these cannot lie in the efficient frontier? And looking at the risk and return combinations, you'll notice only portfolio W cannot lie in the frontier. As it lies below, it has a higher standard deviation than Z with a lower expected return. So on this slide we have the graph of the efficient frontier and the global minimum variance portfolio. And you look at all those dots underneath the efficient frontier. Those are the portfolios which are not minimum variance portfolios. Before we move on to the next step of the Markowitz portfolio selection process, we're just going to look briefly at the capital allocation line. And the capital allocation line is just the line that depicts all the risk-return combinations that are available to investors. So in the second step, we are now going to search for the capital allocation line with the highest reward to variability ratio. And what this means is that you're going to look for the capital allocation line that is tangent to the efficient frontier, that dominates all alternative feasible lines. And the portfolio that connects with the capital allocation line at that tangent point is your optimal risky portfolio. And here again in this slide, it's just a depiction of what would happen. So the capital allocation line would touch the efficient frontier at only one point, at the tangent point, and the portfolio that it connects with is your optimal risky portfolio. And looking at the previous graph, you can see that the objective here is to maximize the slope of the capital allocation line, the reward to volatility or the risk-reward ratio for any possible portfolio P. And here, P is the optimal risky portfolio that we will then combine with the risk-free portfolio or a portfolio with T-bills in order to create our complete portfolio. And the objective function, or the slope of the capital allocation line, is the Sharpe ratio. And the Sharpe ratio is the expected return for the portfolio minus the risk-free rate over the standard deviation of the portfolio. So essentially, the Sharpe ratio, or the slope of the capital allocation line, looks at the excess return per unit of risk taken by the portfolio manager, and you want to maximize this. And so we come to the final step in the Markowitz portfolio selection model. Here the individual investor will choose the appropriate mix between the optimal risky portfolio P and the T-bills. And you would then calculate your risk and return for your portfolio. Now, in this selection process, the assumption is made that everyone invests in the same risky portfolio P, regardless of their degree of risk aversion. Their risk aversion or risk appetite is taken into consideration when they combine it with the risk-free asset. So the more risk averse an investor is, the more they will put in a risk-free asset, and the less risk averse they are, the more they will put into the risky portfolio P. As talked about previously, the risk-free asset are usually government bonds, but government bonds are only free from default risk. The risk-free in real terms only if price is indexed and maturity is equal to the investor's holding period. Here, treasury bills are viewed as a risk-free asset. Money market funds are also considered risk-free in practice. So looking at the separation property, or the separation theorem, tells us that the portfolio choice problem can be separated into two independent tasks. So when we're looking at creating our portfolio and allocating capital, the risky portfolio, the optimal risky portfolio, is purely technical, the determination of that, because it's assumed to be the same for all clients. Allocation of the complete portfolio, that is the combination of risk-free assets and the risky portfolio P, that is dependent on an investor's personal preference. So to reiterate, when an investor is selecting their complete portfolio, then they get to decide what combination of the risky portfolio P and the risk-free portfolio they will use for their complete portfolio. So starting at this slide, over the next 4 slides, an example will be used to demonstrate how the risk and return is calculated for the completed portfolio.